After you have completed the financial statements for an accounting period, it is time to record the closing entries. The purpose of the closing entries is to reset the revenue and expense accounts to zero at the end of the accounting period to be prepared for the next accounting period. As we stated before in previous videos, this helps companies meet the revenue recognition principle and the matching principle, which are required under GAAP, that revenue and expenses are only recorded in your accounting records during the period in which they occur, which means that these accounts have to be zeroed and reset at the end of every single accounting period. Companies can decide how often this happens, whether they close their books every month, they close their books every quarter, or they close their books annually once a year. We use an account called Income Summary to close the closing process. The accounts that are closed are our temporary accounts, which are revenues, expenses, and dividends. Assets, liabilities, and equity are permanent accounts. One of the easiest ways to remember what is a permanent account and what is a temporary account is that anything listed on the balance sheet is a permanent account, and most of the things listed on your income statement are temporary accounts. We will be adding some temporary accounts during this semester, so it's very important that you understand the closing process, the difference between permanent and temporary accounts, and why this needs to happen at the end of every accounting period. We record the closing entries. We close all of the revenue accounts to Income Summary. We close the expense accounts to Income Summary. Then you close Income Summary to Retained Earnings and close the dividends account. We are going to be practicing this in the examples when we're looking at the examples. And again, we'll be doing this throughout the semester, talking about this with a couple of accounts when we're adding some additional accounts that you did not talk about in financial accounting. Okay, once we get to the end of that, then we create a closing trial balance. The closing trial balance only lists their permanent accounts. These are the exact same accounts that are on the balance sheet. You should not have any revenue or expense accounts on your post-closing trial balance. This is an example of the entire accounting cycle, from analyzing transactions to post-closing trial balances. When we have that reverse and post, this is if we need to correct mistakes, and hopefully we don't have to address any of that in this class, and we're just going to post everything correctly. The accounting cycle is a circle because it repeats until the business closes, where we do this over and over and over again until the business is closed forever. The next thing that we're going to talk about is accounting for inventory. So again, where this is a review of financial accounting, and if you haven't taken financial accounting, this is some financial accounting information that will be carried over into this class and added onto. Most of this class will be looking at managing inventory and accounting for various types of inventory. So we have two main types of organizations. So service companies and merchandising companies. A service company sells time or services. Some examples that are listed here are accounting firms, law firms, plumbing services. You can think about a hairdresser that performs a haircut, anything that is a service. They earn revenues for that service, and then they have expenses. They do not have inventory. They only perform services. Merchandising companies sell already created goods and services, goods to customers. This is usually called merchandise inventory. So a wholesaler buys goods from a manufacturer and sells them to retailers. And a retailer buys merchandise from manufacturers and then sells them to customers. So an example of a merchandise organization would be Walmart, Target, Casey's, Hy-Vee, Come & Go. These are companies that have purchased inventory either from a wholesaler or from a manufacturer and sell them to consumers. They have to do inventory accounting then to maintain information about the sale and stock of inventory. When we have inventory, we have an additional account called cost of goods sold that we add before expenses. What cost of goods sold is an expense account. It is the expense of the inventory. So cost of goods sold is the value of the inventory or the cost of inventory that we are selling. So now we have an income statement which, instead of revenues minus expenses, starts with sales minus cost of goods sold. And then we subtract our operating expenses. So we can see when we move from a service company of revenues minus expenses and get to a merchandising company that we're going to have sales minus cost of goods sold equals gross profit. And we're going to add on to this actually because we're going to move in this class from merchandising to manufacturing, and we're going to see how that impacts the income statement and balance sheet with different kinds of inventory. Now on the balance sheet, we have an inventory account in our assets. If we're a service company, we don't carry any inventory. If we're a merchandising company, we do carry inventory. You can see that the inventory is put in here before office supplies. When we create a balance sheet, assets are written in the order of liquidity. And what that means is how fast they can turn into cash. So assets are listed in how fast they can become cash. Cash is already cash. Accounts receivable is expected to be cash, and inventory is hopefully going to be turned into cash when you sell that for revenue. Okay, so that's why those are listed before other accounts. Okay, we have two different types of inventory systems that we use to determine the value of the inventory on hand. One is a periodic inventory system, which requires a physical count of inventory to determine how much is on hand and to determine when we change our accounting records. And a perpetual inventory system, which is a running computerized record of merchandise inventory. We will only be learning accounting transactions related to a perpetual inventory system in this class. Because accounting records are computerized anymore, it is extremely rare that a company would be using a periodic inventory system. A periodic inventory system also violates GAAP by not recognizing revenue and expenses at the time in which they occur. So this is why we're only going to learn a perpetual inventory system other than as a vocabulary term. So some other calculations that we'll be looking at. So one is the cost of inventory purchased. How much is the inventory worth? So what's it going to be listed as on our balance sheet? Okay, we can add additional things such as the freight to have it delivered, and we can remove any discounts. So we have this, what is the cost of inventory minus any returns and allowances, minus any discounts, plus the shipping that we paid to get it to us. When we sell inventory, we generate revenue. We are going to record sales revenue, and then we either receive cash or accounts receivable. Every time you sell a piece of inventory, there are 2 journal entries that have to happen. The first entry records the sales revenue, and the second entry removes the inventory from our records and records the cost of goods sold. So here is an example of that. This is an example of an adjusting entry for merchandising. And this is when the inventory that our computer record says we have does not match what a physical count says. Businesses take a physical count of inventory at least once a year. In fact, if you go to almost any business right now, January is the most popular time for them to take inventory. You will see that several businesses are doing inventory right now and will have different signs up about inventory practices. If what you have physical count does not match what is in your computer system, then you will need to do an adjusting entry for inventory shrinkage. So this happens from theft, damage, and errors. So this is the end of our week 1 review. I know it's a lot of information. Like I said, it's just a very quick review of the financial accounting information that is necessary for this class. This class focuses on managerial accounting, and these are the only things that carry over from financial accounting to managerial accounting. Everything else is managerial accounting specific, but you do need to understand how the accounting cycle works, what the financial statements are, the different types of accounts. Okay, so with that kind of information, you are fully prepared with all the financial accounting information that you need to get through managerial accounting.